For more on the markets and this second to last day of trading, we're joined now by Thwaites. He is the president and chief executive of Sentinel Investments, helping to manage about $27 billion worth of client money. Christian, always a pleasure. Thanks for coming in.
Thank you.
Tell me what you've been doing. I was mentioning that you've been reducing your exposure to stocks in Europe as well as cutting back on emerging market.
Yeah, well, I mean, Europe certainly looks cheap by some numbers. You've got the Chinese stock market on a P of 10, European markets on P as low as 7 and yields of 5. But they deserve that kind of that low rating. I think the growth prospects in Europe, dominated as they are by banks, are looking very poor. And you know, with a very deflationary bias and tight fiscal policy going on in Europe, it's very difficult to see a lot of upside. It's particularly in the continental European markets. There's some interesting markets on the fringe, around the Baltic areas, of course, Scandinavian countries. But I think continental Europe, the large economies, and the UK are not going to be good performing markets for quite a while.
All right, but what about stocks that just happen to be domiciled in Europe? You know, you've got global companies that are European, perhaps in history, but they have now operations throughout the world. What about buying them because other people are just throwing them out and saying, well, you know, we're not going to buy anything that's denominated in a euro?
Yeah, that's a popular story with, you know, companies like BMW and Daimler-Benz who just have great manufacturing plants in Europe and then export from it. But the trouble is most of their stock market rating and valuation is going to be driven by domestic investors in those countries as opposed to the US, and that's going to make them sort of come under pressure.
All right, what about emerging markets, countries like Brazil, for example? We've noticed that stock market has performed terribly this year. I mean, could this be a case of you want to buy something that's much less expensive with the idea that it would increase in value?
Well, as you mentioned, emerging markets, I don't think there's been a single positive market in that index this year, and you know, for good reasons. Most of the currencies are overvalued. That's made it difficult for them to continue their export growth, whereas places like China. Brazil has made it very clear that they've made it difficult for foreign investors to traffic in and out of the stock with some holding premiums if you don't hold the stock for a certain amount of time. And so this has just generally been a bad area. And Russia, of course, is primarily commodity energy driven and is on a very cheap PE. But you know, given its level of sort of clarity and corporate governance, certainly deserves that sort of rating.
So what are the characteristics for the investments that you'd like to hold next year?
I'd still like to hold U.S. equities. I mean, the U.S. equity market is if we finish the numbers as we do today, is the best performing major market.
Dow Jones Industrial Average up about 6%, and the S&P 500 up, let's say, 0.5%.
Yeah, and you know, Dow Jones slightly distorted by high price stock,
We've got Chevron and IBM.
Exactly.
You know, they create just this imbalance in the index.
But it's a good sort of industrial base, and it's of course been a very good you know, part of the cycle for industrials and cyclicals and materials and energy, and all those have done pretty well. And we'd stay, you know, very overweight in those stocks because they're throwing off a lot of free cash flow. They are giving more of their profits to shareholders in the form of dividends and some share buybacks and special dividends. And most importantly of all is growth of dividends. We just saw the S&P grow its dividend level by 11% last year. It's 9% for the last 5 years. So that makes a pretty good cash return on your investment, even if you're looking at a flat market at the index level.
Sounds like you want to keep things simple. You've also been raising some cash.
Yes, you know, that's primarily out of Treasury trades, where we've been sort of trading around this sort of 1.9 to 2.2%, which we've had for a few months now. For the 10 years, so you can strip out about a point or two, sort of getting those kind of, you know, those calls roughly right. So we relatively, you know, high level in cash going into the fourth quarter.
What are you talking about? 15%, 10-15%
normally
cash?
We're fully invested. Right now we're about 15% cash, which is high for us. But that's been even at the 0% level, the zero bound level on cash, that's been a relatively good place to be over the last 6 to 8 weeks, and feels good sort of going into the year new year as you see some buying opportunities.
All right, I want to find out what you're going to do with that cash and what the signals are for you to actually push the button to make those trades. We've got more with our Christian. So we were talking during the break. A client comes to you and says, look, there's a lot of market volatility. No one can predict what's going to happen to the stock market on a particular day. Tell me the characteristics of how you get into a particular stock. How do you wait? How do you maintain that discipline in order to make that trade? Because it's all about the price you pay
Yes. Well, I think first of all, line up the stocks that you want to be owners of over the long term and sort of which are going to represent good values. So that means going to companies with good cash flow, fairly simple business lines, long, visible lines of orders, diversified markets. I mean, some of the, we were talking earlier.
But make this list not in the heat of emotion. Make this list over a period of time.
Yes. For example, we were talking about emerging markets earlier. Personally, I think one of the best plays on emerging markets is through U.S. companies like Hain and Noble Energy and Procter & Gamble and Kraft and people like this. So first of all, identify the companies that you want to have. And when you see a 5 or 10% correction over a couple of weeks, right now, an entry point for us would be at about the 1220 level. So today we're closing about 1265. So if we don't hold that level and we correct it all, then we probably start buying back in again. But when you do see these kind of short-term capitulations and a 2%, 3% off day followed by another 2% off day, that's not a bad time to get in. Providing you've got your list of to buys all lined up and try not to get caught up in the bargains of the moment.
Just someone that's got a lot of experience in this business, you've been doing this for quite a while. What explains these sudden market moves? Because supposedly there's a lot of smart money out there. How is it possible that you can see something fluctuate in value 5, even 10% in a given week?
Well, I mean, this is one of the big sort of dilemmas we've got in the market and how it's changed over the last 20 years. And it is now very much block driven. I mean, ETFs account for roughly 3% of mutual fund assets, probably about 20% of total assets of equity assets, and they represent about 30% of turnover. There's a lot of movement that goes on, triggered by algorithms and asset allocation models, and people looking to hedge and take different positions. So that can affect liquidity enormously, and actually it makes it very nice for us. We are very successful small company funds. So we follow the Russell 2000, and every time that the ETFs buy that, that there's some liquidity problems that they're running into at the lower end, and you can sort of invest around that and outperform the index quite comfortably. But that's basically what's been happening the last few years. You've seen these big block asset calls and very little sort of discrimination at the individual stock level. So it's turning out to be, I think, a much better time for discriminating stock pickers as opposed to sort of block asset trades.
Well, let's talk about some of those as examples, because I think we were all just talking about the comparison between, for example, Philip Morris International and Google.
Yes.
What have you found?
Well, Google IPO'd, I can't remember, 5 or 6 years ago. We haven't really been an investor in it. I think it's pretty highly rated for what is basically an advertising company. But Philip Morris, which makes tobacco products, is a U.S. listed company and spun out of Altria a few years ago. So it basically sells, to very simple products outside of the U.S. I think it's one of the, perhaps the only U.S. company with 100% of its sales outside of the U.S. So it's a very mundane business, but huge cash generator, and it's been very generous in returning cash to its shareholders. It's up nearly 40% this year in a market which is flat. And if you've been a long-term holder,
hit an all-time high yesterday.
Yes, but it's still yielding about what the market yields. Now, 6 months ago it was yielding almost double that, but I think more people have sort of have been looking for dividends. It's going to be a very important investment theme, I think, for the next few years, and that's a company which has got a very healthy, declaration about what it wants to do with its excess cash flow and how it wants to return it to shareholders.
Let's talk about some other companies. Hain Celestial, for example. I know it's one you've been following for a while.
Yes, well, I love that company. It's basically a play on roll-ups of organic and natural foods. So it has a lot of different brands, Hain Celestial being the most famous. It's sort of tea infusion. And by the way, it's a very cheap way to play Green Mountain Coffee, which is on a ridiculously high PE. So you can actually play the tea part of the K-Cups at about a quarter of the price. But it also has other, sort of wellness, natural. One of their brands is Linda McCartney in the UK. And it's sort of been a consolidation sort of roll up and part of the trends towards healthier living and organic foods, and it is one of the few smaller companies that does pay a dividend. It's got a very strong return on equity, very friendly management, and is kind of going from strength to strength.
You mentioned this idea about dividend, but it's about growing the dividend, right? It's not just going out and looking for that high dividend yielding stock.
No, you mustn't do that, because otherwise you'll be led into a dividend trap. I mean, to take BNP right now, the French bank, is on a 5% dividend. It's highly unlikely they're going to be able to maintain that dividend given the new capital restrictions. So you mustn't just go for the dividend screens and buy just on that. I think it's the growth in dividends where management's got a policy to increase them is where you want to look.
Always a pleasure. Thank you very much. Christian Thwaites joining us from Sentinel Investments. Appreciate your insights.
Thank you.